So in this session, we're going to try and talk a little bit about financial statements and the ratios concepts using HUL, Hindustan Unilever, as an example. Fascinating company. So hopefully should be an interesting discussion around what the company is. And we'll try and look at the numbers of the company and try and decode a few interesting concepts when we look at the financial statements. This may be a quick recap for some of us who are familiar with financial statements and a good starting point for some of the others who are not necessarily that familiar with financial statements, right? So I'll begin with the first part around this, which is financial statements themselves, and a quick sort of a recap or rundown around financial statements that we have. There are three broad financial statements that we know of. We have the balance sheet, we have the P&L, and we have the cash flow statement, right? There are different purposes that each of these solve. The balance sheet tells us about what we owe versus what we own. What we owe is all the liabilities. Liabilities are all the people who have given us the money and we need to return it to them. Correct? This would include shareholders who have given money to the company and are entitled to returns from the company. This would include debt holders who have given debt to the company and are entitled to interest and debt repayment from the company. These are the people who have given us the funds. The company can use those funds to purchase business generating assets. On the other side of the balance sheet, you see those assets, which could be long-term assets or short-term assets, right? We'll look at those decoding of those when we look at the financial statements as we go along. The P&L statement is like a report card of the business. This is basically also known as income statement. It is telling you what exactly does the business do, and is whatever they do, is it profitable to do that, right? So what are their sales? What are the costs incurred in doing those sales? And are they at the end of it making a profit around it? The cash flow statement is like a bank statement, a bank account statement that we see, right? So this basically gives you an idea about the inflow and outflow of cash. This could be different, remember, from P&L statement. Suppose I sell these digital marker pens that are there. I sell 1,000 of these for, let's say, 100 rupees each, right? My sales would be 100,000 or 1 lakh, correct? It is possible that I do not collect all of it. My P&L will record the sales and will record the cost and will record the profit that I'm doing. Did my business deal go in terms of profitable venture or no? The cash flow will capture whether I received the money or not. I could just go and tell my client that, it's okay if you pay after 6 months. So that is what is captured by the cash flow. As the name suggests, the cash flow is a flow statement. The P&L is also a flow statement. So these statements are typically periodic in nature, right? These statements are typically periodic in nature, whereas balance sheet is at a point of time. It's a snapshot. You can think of it as if you take your phone and you're taking a video tells you what's happening in a period, whereas a snap or a picture tells you what's happening exactly, what's there in that picture at that point of time. So balance sheet is at a point of time. When you're making a balance sheet, it is as on 31st March 2023 or 31st March 2022. The P&L will be for that period, which is the last financial year. The cash flow will be for that period, right? If I were to sort of make it, visually, what is going to happen is you will have a balance sheet on 31st March 23. And if the business does not do anything, you will have the same balance sheet on 31st March 2024. In going from point A to point B, whatever business transactions you are doing are accounted in the P&L. Essentially, what the business is doing. What are you selling and what are the costs incurred in that selling? All the cash transactions that are happening are coming in the cash flow statement. This is telling you what money came in, what money went out. It may not necessarily be related to your P&L statement, which is it may not necessarily be related to your process of buying and selling something. It may just be, you bought a factory or you raised some loans. All of that will come in the cash flow. It may not come in the P&L. Right? So understand that all statements have a specific purpose. I keep saying that, think of it as, if you look at an architect's view of a home, right? For any home, an architect looks at three views. You'll get a front view, you'll get a side view, and you'll get a top view. Without these three views, it is very difficult to visualize in a 3D space how the house would look like, correct? That's exactly what these three statements do. Without looking at all three of them, it is difficult to visualize what the business is doing. And given three of them, here we have statement 1, statement 2, statement 3, and statement 4. Given three of them, you can derive the fourth one, right? That's what you do when you do financial modeling. You're basically starting with a balance sheet, you're projecting the P&L, you're projecting the cash flows, and then you're deriving the balance sheet for the next year, right? So that is the construct. That's a very quick recap of what that comes up. Remember, balance sheet, point of time, P&L and cash flow, periodic statements. Balance sheet tells us the financial health or situation of the company at a particular point of time. It tells us who are the people who have given us the money, and it tells us where have we applied that money. Sources of funds equal to liabilities, application of fund equal to assets. Fair enough? That's the construct of a financial statement. How does it look like, and what do you really go about looking at in those numbers, right? There are more nuances. We will come to them as we kind of go along. A very quick sort of breakdown of the balance sheet. You will have on one side assets, and you will have on another side liabilities. Now, depending on where you are with geography you are, it could be top, bottom, left, right. That's okay, irrelevant. We are looking at it more from the perspective of analyzing it. Liabilities could be internal, so liabilities and equity, but I've just sort of clubbed them together. So internal to the company would be equity holders, people who are shareholders in the company and have given money to the company. You could have external liabilities like debt, and you could have short-term liabilities, which are current liabilities, things like payables. Your supplier has given you the material, but you have not made a payment for that, or your customer has given you an advance, or there's a short-term loan. All of these are short-term liabilities that would come up. On the asset side, you will have long-term assets. This could include tangible assets. Tangible would be the ones that you can see, look and feel, factory, land, car, etc. These could be intangible assets. Intangibles are the ones that you cannot sort of see, feel, and all. So these would be license fee, brand value, goodwill, and so on and so forth. We'll see some of this interestingly in our case at hand today. And you could have current assets. Current assets could include, cash, short-term investments. It'll include receivables, stuff you've sold but not collected money for. It'll include any kind of prepaid advances to suppliers. It'll include inventory, right? So all of that would come under the current assets bracket. Obviously, the source of funds that you have taken will equal application of funds, or it would be lying in the cash and bank balances of the company. So that's how the financial statement would look like. P&L is a fairly straightforward sort of a statement. You will see revenue, which is the top line or sales. Whatever you're selling, what is the amount you have made by selling that, minus costs. These costs will include costs of the raw material, the goods that you're selling, employee cost, and other costs. That gives you what is called as EBITDA, or operating profit, earnings before interest, tax, depreciation, and amortization, minus depreciation slash amortization minus interest minus tax gives you profit after tax, right? So I won't spend too much time sort of digging into this. You probably already know about some of this, and there's enough material available on this, so you can go and check that out. Let's jump right into our case at hand, which is HUL, right? So what does HUL do? Let's look at a very quick business detail. HUL is the Indian counterpart of the global player Unilever, and they have a bunch of brands that are there. It's a large company, approximately 60,000 crore of worth of sales annually, close to about 8 to 10,000 crore of profits annually. Large market cap. It is one of the top 10 in terms of market cap. In fact, it's in the top 5 or 6 in terms of market cap in India, market capitalization in India. 9 out of 10 households in India use one or more of their brands. This is just a grab from their annual report. They have a reach of 9 million retailers, 1,300 key suppliers, 75% winning, business winning market shares in categories that they're in. 1.2 million retailers use their app. 31,000 crore spent on materials, basically raw materials, etc. 19 brands with turnover exceeding 1,000 crore per annum, right? So a big player in the FMCG non-discretionary space in India. and 65 billion units manufactured, whatever they do, soap, food, personal care, etc. kind of items. This is their sort of brand details that are there. So, three major segments. One is beauty and personal care, which has in it basically all your skin cleansing, which is the soap and hair care business, and then skin care and cosmetics and deodorants and all of that are there. And you'll find a bunch of brands which are like very big brands. Technically, for example, in the soaps market, a Lifebuoy and a Lux would be in the top 5 in India, and put together all the soap brands of HUL would probably occupy close to 35 to 40% market share in the soap segment itself, if not more. Right, my data could be a little bit dated in this case. Then home care, which is all your fabric care and household care and water purifiers, etc. And foods and refreshment, which includes beverages, health food drinks. This was through an acquisition that came up in 2020 of GSK Consumer Healthcare. So we'll talk about that in a little bit more detail. Ice creams, foods, all of that put together. So that's their core business pie, the core brands that exist for HUL. Look at the official highlights. This is standalone numbers, but we'll be doing our calculations on consolidated numbers. Turnover of close to 60,000 crore, EBITDA of 13,000 crore, PAT of close to 10,000 crore, right? And then there are a bunch of data points which are available in terms of what kind of growth they are doing and so on and so forth, and what kind of numbers we are looking at in terms of their performance, correct? Segmental performance. In terms of how much of their revenue comes from what segment. So if you look at the overall segment of about 60,000 crore, nearly 35% coming from home care, 35% odd coming from beauty and personal care, and the remaining comes from food and others, essentially. And this is in revenue terms. In terms of profitability, the biggest profitability is beauty and personal care. This is EBIT, segmental EBIT, or earnings before interest and tax. Home care follows next. So home care margins might be lower if you think about it. With almost the same sales in both these segments, the profit numbers are varied in the segment. So beauty and personal care, because of their branding, they're able to generate a higher margin. Home care, not as much. Probably more competitive players also kind of come into the picture, right? That's one part of the context. Then there is foods and refreshments and other parts of the business as well. This is how a consolidated balance sheet of theirs would look like. Right, so you'll see on one side you will have their assets, and I'm just showing the assets for a minute for us to kind of grasp and take a look at a few things in their overall asset size. So their overall balance sheet size is about 73,000 crores, right? Reasonably large company, 73,000 crore asset book. But if you look at their breakup of assets, non-current assets is the larger component of that. Long-term assets or non-current assets is the larger component that is there, right? These are, assets that would have a useful life of more than a year, essentially. Within this, you will note something very interesting, that plant, property, and equipment is actually, which is the factory and land and all of that they own, that's a very small component. That's less than 10% of their overall balance sheet size. The bigger components that come is there is some intangible assets that you see here, and there's another intangible asset called goodwill that comes here. So we'll try and understand this in a little bit more detail as we go about that. Nearly, in fact, more than half of their balance sheet size comes from these two line items, right? And that's a very interesting or intriguing situation for a company to have. It's important to understand where did this come from and what happened here. When we look at ratios, we'll start understanding a few things here. I will give you a very, very quick brief about ratios that we are going to use. And then we will jump to the Excel file, try and start working on that and try and look at some interesting aspects of things that come up. In the ratios, we are going to look at profitability ratios, which tell us effectively how profitable a business is. Now let's understand, what does a ratio mean? A ratio is just a relationship between two numbers, either both financial numbers or one financial and one business number, where one is driving the other or one is related to the other, a numerator and a denominator. And it is just trying to standardize the performance of a company so that we can make it comparable either against its own history or against peers. For example, if there are two companies, one has a sales of 2,000 crore, another has a sale of 10,000 crore. The 2,000 crore company makes a profit of 500 crore. So this is sales, this is profit. The 10,000 crore company makes a profit of 1,000 crore. In the absence of any other information, if I just ask you basis on sales or I ask you basis of profits, you'll say company 2 is better. But now that you have a standardization mechanism where you can say, okay, what is the profit per rupee of sale, right? So I can divide the profit by sales. So you'll see 25% is my profit margin, whereas 10% is my profit margin. A ratio is giving me a comparative judgment between two companies. That's where ratios are useful. We have profitability ratios. So let's actually erase all of this. Let's try and write this again. We have profitability metrics or ratios that would come up. These would be typically, EBITDA margin, or what is called as operating profit margin, calculated as earnings before interest, tax, depreciation, amortization divided by sales. You will have net profit margin, which is calculated as net profit divided by sales. For every 1 rupee of sales, what is the EBITDA that you're generating? What is the net profit that you're generating is what is being covered here. You will also have something called as return ratios. There are a bunch of return ratios that come up. The most common ones are return on equity and return on capital employed. Return on equity is what is the return you have made for shareholders, which is your net profit divided by what your equity holders have as their share in the company. This includes share capital. That was the initial part they put in, and I'll show you on HUL's balance sheet what else does it include. Any profits made but not distributed, which kind of go and become a part of retained earnings, come and sit here. So that's the equity. In capital employed, you will have equity. You will also have debt. People who have given you equity and debt. Because the denominator includes equity and debt, the numerator can't include only net profit. You would want to include EBIT because that includes the interest component as well. So now you have the numerator, which is inclusive of net profit and interest, and the denominator, which is inclusive of equity and debt, right? I'm just giving you simple explanations around these. These could have variant forms. You could take averages. You could, sort of have a slightly different formula. That's okay. Any ratio, you're free to sort of change the formula a little bit here or there, as long as you are comfortable. You are consistent, which is you're using it the same across the segments that you're using it at, and see there's a logic behind why you're changing that formula. That's fine. There's also another ratio called return on assets, for example, where you will take total assets in the denominator. Numerator, some textbooks say use net profit, some textbooks say use EBIT. I prefer using EBIT because total assets are equivalent to total liabilities, which include equity and debt. So on the numerator, just to be consistent, EBIT can be used. Then there are some other metrics which are sort of debt ratios or stability ratios. So I can use debt metrics. So there's something called as debt to equity, where we will see total debt or total borrowings of the company divided by equity of the company. Again, some textbooks give you long-term debt upon equity, but I prefer using total debt as long as you use that consistently everywhere. Just gives you a broader picture of how much debt a company has. And there's another one which is important that comes here called interest coverage ratio. How much does your profit before interest and tax cover your interest by? So EBIT upon interest. Again, some textbooks give you EBITDA upon interest. That's okay. You can use that as well. There's no problem around that, right? And then there are a bunch of other ratios, which would be, let's say, called efficiency ratios, or what is called as turnover ratios. Here again, textbook definitions are slightly different and the industry uses slightly different metrics. So these are called as turnover ratios. For example, you could use what is called as a total asset turnover ratio, right? And you'll use sales upon total assets. Basically, what is the kind of sales you're generating per rupee of asset deployed tells you how profitable the business is or how efficient the business is. How much extra sales can you generate for the same amount of assets used? The higher, the better, right? You will have receivable turnover. You will have inventory turnover, right? So receivable turnover will be sales upon receivables, and inventory turnover will be sales upon inventory. Again, textbooks will tell you COGS upon inventory, but in the industry, typically for keeping it consistent and sort of comparing it across companies, sales upon inventory is a better metric to be used, right? That's all we are going to calculate. Let's jump right into the balance sheet and P&L. Let's look at the Excel data and try and understand that. Give me a second. Let me share that with all of us. Okay, so here we go. Here we go. Can we see the Excel file? Right? So if you look at the Excel file here, this has balance sheet data for the last 4 years and P&L data for the last 4 years. This is consolidated data. Remember, consolidated means it includes all subsidiaries as well. Now, if you recall seeing our earlier data points, your calculation of overall sales was about 58,000 crore there for standalone. So there aren't too many subsidiaries here. Small bits of subsidiaries, about 1,000, 2,000 crore of sales that comes from there. So less than sort of 5% of their overall sales is coming from subsidiaries, right? We have all this data on the P&L, and you will look at the P&L. You'll start with, some of these line items. I can quickly explain those. Revenue from operations, whatever business you're doing, what you're generating there. Other income, ancillary income. For example, the company could have money in their bank account and they're earning some interest on it. That's other income, right? Then you have these line items, cost of materials consumed. This is the raw material you purchased and used in the business. Purchase of stock in trade. Let's say you bought something and sold it straight away, right? You just white labeled it, put your brand on it and sold it out. That's purchase of stock in trade. You didn't really manufacture too much over it, right? If you look at a company like DMart, you'll find this would be your biggest component. This is the only component because DMart doesn't produce anything. They purchase and they sell, they purchase and they sell, correct? Changes to inventory is there to sort of incorporate any matching principle scenarios because you have bought raw materials, right? You may not have sold everything. So your sales are capturing only that part of the raw material which has been sort of sold. But your cost of materials includes everything that you purchased. So you adjust that. If this is a negative number, basically you have sort of not used that in this particular year. So you reduce the raw material cost to that account so as to match it with the sales of the products that have been sold and remove from the raw material cost, the cost of the products that have gone into the inventory. Employee benefits, straightforward. Finance cost, interest, you'll see a very small number, don't have too much debt. So that's simple. Depreciation and amortization, again, not a very large number, not a very asset intensive or capital intensive business, right? That's the construct of what you see here on the P&L. There are other items, we'll come to that. On the balance sheet, you will see once again, there's a bunch of data that is there. I would want to point out attention towards a couple of interesting things here. Look at their overall balance sheet size, which is total equity and liabilities or total assets in 2020. And you will note that this number was effectively close to 20,000 crore, but spiked up dramatically in 2021. This is essentially the acquisition that happened with respect to GSK Consumer Healthcare. We'll talk about that, what really happened, how that happened, and what that changed in the business, right? Let's look at some of the metrics and the ratios that we are going to calculate along with this. So that's the spectrum of the balance sheet that is there. We'll jump right into calculation of ratios. So there's a bunch of ratios that I have mentioned here, right? We will write their formula very quickly. As I said, I'm not a very big stickler for formula here. You're free to sort of change that here or there a little bit. As I said, certain formula, various textbooks give you various things. Just use it uniformly and consistently everywhere you're using it. That's okay. Have a logic around it. I'm using a simplistic definition that suits our purpose at this point of time. You don't need to take this and say, this is the only way you can calculate formula, right? So just be with me on that. Operating profit margin is EBITDA divided by revenue from operations, only operating revenue, correct? And this is net profit divided by, you can take revenue from operations or you can take total revenue as well. That's okay. In this case, right? We'll take revenue from operations. Return on equity, net profit divided by total equity. ROCE, EBIT divided by equity. Sorry. ROCE is this divided by equity plus debt. Debt to equity is total debt, long-term plus short-term divided by equity. Interest coverage is EBIT upon interest. Receivable turnover, sales upon receivables. Once again, you can use averages if you want. That's okay, right? Sales upon inventory and sales upon total assets, right? Then there are some cost to sales ratio. We will come to that as we go along, correct? Let's start with our first one. Now, remember when the P&L is given these days in terms of the accounting principles, that the way it is represented, you are given this line item called profit before exceptional item before, and tax and before share of equity accounted investee. right? This effectively is your PBT number, profit before tax. To arrive at EBITDA, I need to add depreciation and interest to this. So PBT plus interest is EBIT, plus depreciation is EBITDA. There's one more change that you have to do. This includes other income. I do not want to include that. As an operating level, I want to remove that from the components that are there, right? So that's what we are looking at. Correct. Sales is the same as revenue in all the scenarios that we are looking at. So revenue from operations is the same as sales. That's what we are using, right? So I will calculate these numbers, the EBITDA and EBIT, they are calculated here. So note the calculation. Let's actually delete this and do it again, right? So my EBITDA is equal to profit before tax plus depreciation plus interest cost. But this includes everything, including other income. I want to remove that, right? Okay, I have basically linked incorrect cells. This plus depreciation plus interest cost minus other income, because other income is included there in this formula, right? Once again, have I connected it correctly? No, this should be B5, right? And from this, if I remove the depreciation, right? If I remove this depreciation and amortization bit, then basically I will get the EBIT. So these are the numbers, we get them here. Let's quickly calculate the ratios and look at something interesting here. So EBITDA is here, divided by revenue from operations, that's this. I'll change them into percentages as we go along, so we'll format that. Profit after tax for the year divided by revenue from operations, that's here. Return on equity is net profit, final profit after tax, that is 6764 for this year, divided by equity. So equity, if you see, is equity share capital and other equity. So you add both of these. We'll take total equity because that non-controlling is a small number and we've anyway included that there. So total equity is what I'm going to use in the denominator. That's this number, 82%, right? Note this number. It'll be interesting to see what happens after this. Let's look at EBIT divided by total equity, which is this, plus debt, borrowings. So you'll see financial liabilities, there's nothing here, 0. You'll go down, you'll go down, you'll go down. You'll also take lease liabilities actually, because that's now a conversion that has come up. Borrowings and lease liabilities, right? So what are the cells that I have taken? I will explain that to you. On the balance sheet in terms of borrowings, I have taken these two, right? I've taken these two because my finance cost actually starts including them at some point. Lease liabilities start coming in from 2020 onwards for most companies. There's a separate concept around it. We won't get into the details of that here, but just assume that these are 4. If you want to remove lease liabilities, you can remove and choose only the 2 borrowing numbers, which is financial liabilities and borrowings. In this case, there's nothing, so really nothing to worry about. Total debt upon equity is essentially going to be only the borrowing number. So let's put a bracket. It's going to be close to 0. This plus short-term borrowing divided by my equity number, which is here, right? EBIT upon interest. EBIT is here. We calculated it, divided by finance cost. Any number above 3 is good. This company has 75. Sales upon receivables. So let's look at sales, revenue from operations divided by my receivable, which will be on the asset side, current asset, inventories, trade receivable. That's this number. And inventory is going to be sales divided by inventory. Let's go to inventory very quickly. That's here, inventories. What does it mean? My inventory, the times I convert it into sales is about 14 times. So my sales is actually 14 times of my inventory number, right? And my receivable, sales is 34 times of receivable number. If I divide 365 by this number, I can get days of receivable. So basically, if I do is equal to 365 divided by this, what it means is that receivable number, look at this receivable number here on the balance sheet. That's this 10, sorry, where has it gone? Here, 1149. This is equivalent to about 10 days of sales. 10 days of sales recovers this amount that is stuck as receivable, I think your inventory would be about 20, 25 days, something of that sort of sales. So money is stuck in these assets. How much time will it take to recover them? Total asset turnover, sales upon, right? Sales upon total asset, non-current, current, total asset, right? Now look at something interesting. Let's first change the ones. These are represented, the first 4 are represented in percentage terms, right? The others are represented in decimal terms. So I'll add 1 decimal point to all of them, right? Let's pull this on the right side and see what happens to the numbers. So you will see one by one, the core for anybody who's analyzing statements is not really calculating these statements. The core is now going and digging into what's really happening. You will note remarkable consistency in operating margin for the first 3 years. Last year seems to be some cost pressures in last year. Stable and consistent profit margin, right? Profit margin looks good. Net profit margin. They seem to be making that 16.7 to 17%. Again, minor dip in the last year, but not really a very meaningful number. There's an interesting dip in this number. Return on equity was 82% for them in the initial years, and that dropped dramatically to 16%. Same for return on capital employed, dropped dramatically. Now, why did this happen? The culprit here was the acquisition that happened. We'll look at what that did to the numbers and why this is not necessarily bad, right? Because there's a logic why that happened, and it's important to understand that deal in terms of what really happened. The equity base went up when they acquired GSK Healthcare, right? And that's what caused this thing to happen. Interest coverage, fairly stable and comfortable in that context. You will note receivable turnover ratio has gone down, right? Now this number is fairly stable, but receivable turnover has gone down post this acquisition, which means sales divided by receivables, it was 34 times initially, that's gone down. Whatever they are selling now, there's a little bit more receivable that's coming along, right? Look at the receivable jump that has happened. Their channel, they're probably giving a little bit more leeway in terms of whatever they are selling, right? Could be partly because of the acquisition, could be partly because of what's really happening in the end consumer space. They want to be probably competitive, and hence that is happening. But this is something you want to kind of analyze a bit more. Why is this dropping? Or in other words, why are receivables piling up? If you just take the reciprocal, which is receivable as a percentage of sales, that would be essentially going up, correct? So why is that? What is happening there is something that is important to understand. Now, there are 2 points that are relevant here. One is this dip that we need to understand what really happened in this dip. And one way to analyze this is something called as DuPont analysis, right? So if I go to the data here, we can talk about something called as the DuPont analysis. DuPont analysis is something that breaks down the return on equity. What is return on equity? It is net profit upon equity. Now extend it, a 3-stage DuPont essentially, multiply it with sales upon sales, and multiply it with assets upon assets. I can do that, basically multiplying with 1 and 1, correct? Now rearrange. So net profit by sales into sales upon asset into assets upon equity, correct? The first term here, this one, is my profitability ratio. It tells me how profitable the business is. The second term here is an efficiency ratio. It tells me how much sales am I generating per unit of asset that is there. The third term here is the mix of capital. Remember, assets can be loosely written as equity plus debt. So it's like equity plus debt upon equity. If a company raises a lot of debt, this number can spike up, which can cause a spike in the return on equity. So it's not always that. So this is called the leverage factor, right? If return on equity is going down, you have to check which of these is pulling it down. If return on equity is going up, you have to check which of this is pulling it up. If assets upon equity is taking it up, it is possible a company borrowed a lot of money that resulted in return on equity going up in the short term. That may not necessarily be good. So a DuPont analysis basically allows you to break down the return on equity into these three components of profitability, efficiency, and leverage, and try and see where is this impact coming from, right? Let's go to our Excel file and try and note this down. So I know my return on equity. I already know net profit margin. I also know total sales upon total assets is available here. If I want, I can basically write down ROE. I can find out net profit margin. I can find out asset turnover ratio, and I can find leverage. Leverage is what I need to find out. Leverage is essentially assets upon equity. So I can go to the balance sheet. We can take total assets, right? Total assets is going to be here divided by equity, total equity, right? And my asset turnover ratio is already available here. You'll note this is what dipped, and my net profit margin is already available here. If I take the product of all these three, I will get my return on equity number, which is the same as what we calculated here, right? You can drag it on the right side, and I can basically do this. You will note that both asset turnover dipped and leverage dipped. Now, this is a unique case. It is not necessarily bad in their case because of these numbers that come up. Look at the balance sheet. Look at the numbers that spiked up. There is a goodwill and there is an other intangible asset. So let's understand the deal, right? HUL in 2020 decided to basically purchase the GlaxoSmithKline consumer healthcare business, which is Boost and the Horlicks brands which are there. In this, they acquired the brand Horlicks, intellectual property right of brands like Boost, Maltova, and Viva, and rest of it. For this, there was a share swap that was done. So existing shareholders for GSK Consumer Healthcare were allotted 4.39 shares of HUL. So essentially a share swap deal. More shares were issued, and this was given in lieu of the assets that got acquired. So the way the balance sheet got structured was on the equity side, equity base increased because number of shares increased, right? So 18 crore shares were issued, and the price of the share was about 2,000 rupees. So you multiply, 40,000 crore was the consideration that was paid. Now remember, the balance sheet size before this was 20,000 crore, but market cap was very high. Because of that, 40,000 crore was issued, and this was about, I think, 10% of the market cap at that point of time, which resulted in GSK Consumer Healthcare coming in. So on the equity side of the balance sheet, equity worth 40,000 crore has been added. You'll see that on the balance sheet equity side, right? You have to balance it on the asset side. Now, just like other FMCG businesses, GSK would not have had too much fixed asset. What was being acquired was some of these brands. So there was a calculation of what is the value of this brand that was done. So these brands such as Horlicks and Boost were iconic. So basically they calculated what is the value of this brand, right? If you look at what really happened here, so they calculated the value of the brand, and this value was about 27,000 crore. And overall consideration that was paid, which is, this 40,242 crore. Out of this, there were intangible assets like brand, there were tangible assets that were acquired, other net assets, any other liabilities, etc. And then there was something called goodwill. Now let's understand a minute what goodwill is essentially, right? Let me rub this. Goodwill as an asset only comes on the balance sheet when company A acquires a company B and overpays. So company A, let's say, paid 1,000 crore of cash to acquire assets of company B, which were only 500 crore. So the transaction is cash worth 1,000 went out, 500 worth of assets come in. That's a problem. So you have to adjust it. So to adjust it, you will add a plus 500 of a fictitious asset called goodwill. The assumption is that you must have paid for the brand value or goodwill that exists. In addition to the defined brand value that you calculated and added there in the balance sheet, this is anything extra, you're assuming general goodwill, right? Goodwill technically is to be tested for impairment every year. In plain simple English, you have to ask a question. If I were to sell these assets again in the market, will I get the same amount? Will I get 40,000 crore? If the answer is yes, you carry it as it is. If the answer is no, you have to write it off, right? That's what this company has done. When you look at the numbers, you have intangible assets worth about 28,000 crore that were taken. And there was a goodwill on consolidation of about 17,000 crore that came into the picture, right? This goodwill remains the same, which means every year the company tests it for impairment, but finds that if they were to sell these assets, they will get this money, which is reasonable as well, right? It is likely that is going to happen. And that exactly is what this line item kind of comes in, right? So what would have happened is HUL would have gone to GSK Consumer Healthcare and said, look, I want to acquire these brands, right? GSK Consumer Healthcare would have done some analysis and said, look, Boost and Horlicks are worth 28,000 crore. So that's the value that is there. But my business is worth even more because it was a listed business and it was trading at, let's say, 40,000 crore market cap. So you have to acquire the entire thing by issuing your shares, right? So anything over and above that brand value that HUL has had to pay will be counted as a goodwill. That goodwill is a fictitious asset. It comes and sits here, right? Now, remember, in this particular case, because this is FMCG and there is a brand value that is involved, it's fine. In other businesses, if you find a goodwill that is coming, you have to be a little bit careful, because technically, if the company closes today, all your liabilities are basically going to get settled, assuming these assets get this value, right? In this particular case, the liability is all equity. So it's not such a big problem. Sometimes you will find balance sheets of companies where debt is very large on one side, and on the asset side, you see a big goodwill number. There, the repayment of debt depends upon the company being able to get this value out of goodwill, right? So that's the construct that is important when you're looking at HUL as an entity. What has really happened in this transaction? Those are some of the numbers that we have seen. We can very quickly look at raw material cost as well, right? So raw material cost typically is the sum of these three line items put together. So I will add all these three and divide it by revenue. That's my cost of goods sold, basically, or raw material cost as a percentage of what is sold. Employee cost as a percentage of sales is 1,800 divided by 39,000. So that's not a very large number. Once again, you'll find in this business, roughly 50% of your cost is raw material cost, 5% is employee cost. There's a large chunk of other expenses that would come up as well, right? Now, this detail of other expenses would be available in the annual report. If you go and dig deeper into these numbers, you will find that other expenses will include things like a lot of marketing expense, right? Advertising expense would come up here. Any distribution expenses that are happening would come in this. So you could see those segregations. Interestingly, HUL also pays a royalty of close to about 2.5 to 2.6% of their sales value to Unilever annually. That is also included here. So you will find your royalty and marketing expenses are all included in the other expenses component. That's something you want to keep an eye on. Those are some of the core ratios that are there. That's some of the things we tried and understood about goodwill. We tried and understood about why return on equity went down. We explored what DuPont is. We explored the idea of how the company's goodwill kind of comes if one company acquires another company and there's a fictitious asset added there. We saw the deal of HUL and GSK Consumer Healthcare. Through the lens of HUL, we tried and looked at some of these numbers, some of the ratios that we wanted to kind of understand, that we kind of wanted to recap. That, in a nutshell, is what I had to discuss in this segment.